Welcome to the deep dive. You know that feeling. Investing feels like this high-speed chase. So much noise, these temptations for quick wins.
Yeah,
It's overwhelming.
totally. Information overload.
Exactly. So today we're kind of hitting the brakes. We're doing a deep dive into Jim Collins' book, The Case for Long-Term Value Investing.
Great book. Really cuts through it.
Yeah, the idea is to help you, our listener, find a clearer path, a disciplined way through all that market chaos.
And Cullen's own backstory is, well, it's pretty fascinating. He started out as a Navy officer, right? Back in the 60s.
The booming 60s market, yeah.
Right. And he thought, oh, this is easy. This is fun. Picking stocks seems simple. But then, wham, the crashes came. Late 60s, 70s.
Ouch. A tough lesson.
A really tough lesson.
Yeah.
But that experience, that sort of baptism by fire, it completely changed his approach. Led him straight to Ben Graham's ideas.
The father of value investing.
The very same. And eventually that led him to start his own firm, Schaefer Cullen. Huge firm now, like $20 billion under management. Shows how hard-won experience shapes strategy.
Okay, so he learned the hard way. How did he boil those lessons down into something, repeatable for us?
Well, he really hammers home what he calls the enduring power of value disciplines. It's classic Graham, really. No fancy stuff.
So what are the specifics?
It's basically three main screens.
Mhm.
First, look for stocks in the bottom 20% based on price to earnings, or PE, what you pay for profit.
Got it. Low PE.
Second, bottom 20% by price to book, PB, comparing market price to the company's sort of net asset value.
Okay.
And third, the top 20% by dividend yield. So companies paying out solid cash relative to their share price. Spotting value others might be overlooking.
Clear screens and the long-term part you mentioned earlier. That's critical.
Oh, absolutely vital. Cullen emphasizes using a 5-year time frame. It helps smooth out the bumps,
Right. Avoids knee-jerk reactions.
Exactly. It lets the actual company performance, the fundamentals, drive your returns, not market sentiment or your own fear and greed. And history backs this up.
Like the study you mentioned.
Yeah, there were early studies, like Paul Miller's in Barron's way back in '77. It showed pretty clearly that the lowest PE stocks just consistently beat the higher PE ones over different periods. It works.
Okay, so screen for value, be patient. But fundamentally, why do these stocks go up long-term? Cullen connects it to earnings and dividends, right?
Precisely. The core idea is super simple. Stock prices ultimately follow earnings. And the amazing thing is, earnings tend to double roughly every 10 years.
Even with recessions and all that?
Even with recessions. Companies adjust, they cut costs, they innovate. That underlying growth engine is powerful.
Okay, earnings drive prices. What about dividends? Are they just like a nice extra?
No, they're much more than that. They're often the steady hand, especially when things get choppy. Dividends are usually smoother, less volatile than earnings.
So they provide stability.
Huge stability. Think about it. S&P 500 dividends actually increased through most recessions between 1940 and 2020. Even nasty ones like
Yeah.
73, 75, or the early 80s double dip. Yeah, they provided crucial downside protection. The only real blip was the 2009 financial crisis when banks basically had to cut them. Yeah. But generally, very reliable.
So earnings and dividends build the foundation, which brings us to what Tulling calls the silent killer, market timing.
Ah, yes. The big temptation.
It feels smart, doesn't it? Trying to jump out before a dip, jump back in.
It feels smart, but it's incredibly dangerous. Cullen tells this story, client A versus client B. Client A just stayed fully invested. Client B tried to time the market, moved to cash 5 times over 20 years.
And the difference.
Get this, client A had 1,000% better returns.
1,000%. Just by staying put.
Just by staying put, not trying to be clever. It's staggering.
That really drives the point home. It's like trying to catch every single wave perfectly.
Exactly. You miss the best days, and it kills your returns. Prudential did a study back in '91. Missing just the 10 best months over 30 years wiped out the entire stock market advantage. Gone. Sir John Templeton had it right. The best time to invest is when you have the money. Forget timing. Cullen points out those moments of maximum pessimism.
Like the death of equities cover.
Yeah, Business Week, 1981. Those moments often turn out to be the absolute best buying opportunities, historically speaking. But you have to be in the game.
So wrapping this all up, what's the big takeaway for you, the listener, from this deep dive into Cullen?
I think it really comes down to appreciating the power of compounding and just staying the course. Einstein supposedly called compound interest the eighth wonder of the world.
And Cullen shows there are always reasons not to invest, right? He listed decades of crises and fears.
He did. From 1934 to 1990, just this long list of obstacles the market eventually overcame. It's about perspective,
So the final thought really comes from Bernard Baruch.
a timeless one. Now is always the hardest time to invest.
It always feels uncertain.
Always. So the challenge for you is, get started if you haven't. Keep adding steadily. Be disciplined about the price you pay, like Cohen advises. And crucially, just stay invested. Avoid that silent killer market timing, patience and discipline. That's where the really dramatic long-term results come from.